Welcome to Everything Life and Real Estate. Let's get started with our hosts, Linda McKissick and Dana Gentry.
I've got to believe that the bulk of successful agents are an entity instead of a soul. I just have to believe that.
Yeah.
I think they are. Yeah. I mean, I think most of our agents,
Just don't do anything. Just don't file anything. Don't make an S corp or an LLC. Is that what you mean?
Yeah, I'm thinking of like how we pay people, through the office. And we pay a lot of people directly to their name, not necessarily to an LLC. I would say the bigger agents and the bigger teams, that the ones that are making more money we're paying them through an LLC or an S corp of some sort. But then we have a lot that are individual. Yeah, I think it's probably based off of our top 20%. I would say top 10 to top 20%. But I would say a lot of other agents they're not.
Gotcha.
I don't know if that's a good question to ask. I mean, to look into to see though.
Okay. Well, number 8, stepped up basis, and this is not funny, everybody, but one of the greatest tax forgiveness provisions of the Internal Revenue Code happens to be death. All right, and I'm not trying to be funny, but here's the point. All right, so let's go back to Tucson, everybody. We bought it for 180. We depreciated it way down. All right, and just assume that I'm a single person. All right, and I own that property. And then it's worth $369. And then instead of selling it, I passed away, everybody, and left that to my only sister, Linda McKissick. Are you with me on this? All right. Well, everybody, here's the deal. So my basis was way down to probably $50,000 or $60,000. The value on the date of my death is $369. I leave it in my will or my trust to Linda McKissick. And her basis, everybody, is number 8, stepped up to fair market value, stepped up. So number 1, that gain that I would have paid tax on, that $50,000 of tax, is forgiven. Right? It's just forgiven because of my death. Linda picks up a $369 basis and starts depreciating that all over again. And I'm telling you, everybody, stepped up basis is one of the most powerful and significant tax benefits. The problem is somebody's got to die for it to happen, but that's just the way it is. Now, the other side of it is also this. If Linda's going to get stepped up basis of $369, then that $369 is in my estate, everybody, in my estate, if I left that to her in my will. And then we come into what is called federal estate tax, and the current exemption per person is $12,920,000 per person in this country. So the three of us on this webinar right now, it is 3 times 12,920,000. And very, very few individuals in this country have a net worth in excess of $12,920,000. So for the most part, stepped up basis is really good because there's no estate tax on the owner decedent side because of the $12,920,000. Stepped up basis is powerful. Now, number 9, okay, and you're welcome to pull me back on anything I talk about. For those of you that are, and I'm telling you, you're making 900,000 GCI, and I'd even step down to 500 or more GCI. The typical retirement plan that people think about are SEP IRAs, solo 401ks, safe harbor 401ks. All of those are for the self-employed. But if you're making a lot of money, and I've been talking about this since I was speaking for Howard Brinton, because he had some heavy hitting stars, the cash balance defined benefit plan is superlative compared to the defined contribution plans like SEP IRAs and 401ks. And Linda, and without ever mentioning names, but you'll know who I'm talking about, just in the last 2 years, 3 or 4 of Howard Brinton stars, now retired, have come up to me in various conventions or seminars and thanked me for pointing them in the direction 25 years ago of number 9, the cash balance defined benefit plan, because they were retiring from the business of real estate with between $4.5 to $5 million in their retirement plan, all because of number 9. And here's the theory of it, all right? The 401ks and the SEP IRAs define the amount of your contribution. Well, the defined benefit plan, everybody, is this cup, all right? They allow you to put money into your retirement cup that when you retire will be able to pay you over $250,000 a year in retirement income from your benefit plan. So what it comes down to is how much are you allowed to put in a year to this cup to build it large enough to pay you out this large amount of money when you retire. So that's the cash balance defined benefit plan. Although I will tell you this with a smile on my face. So again, in Minnesota, of this week, Linda, I had spoken at Celebration, Sarah's Celebration in Phoenix a year and a half ago, and was touting number 9. And a realtor from Minnesota had started this when she got back. And she looked at me like this, what? Right? Because the only downside of the defined benefit plan is the amount of money you have to contribute every year. That scares some people about it when they see that number that has to go in every year. So anyway, it is what it is.
How do you know what that number is? Is it individual?
I was just getting ready to ask that.
What's that?
How much is that amount? Is it different for each
person?
Okay,
so number one, an actuary, ladies, comes in to determine that amount. It's a function of your age, your current accumulation of retirement assets, the age at which you want to retire. The actuary comes in with a study of all these things, and they determine how much you can put in. But if a SEP IRA's limit is like $50,000 or $60,000, it's actually $66,000 in 2023. In many cases, I've seen the cash balance defined benefit plan contribution being easily over $150,000 a year. Pretty heavy.
So it sounds like, though, if an actuary is going to have to come in and do that, you want to do something like this before you start having a bunch of real estate assets. This only measures your retirement assets. It doesn't measure your net worth, Linda, from anything else other than your retirement assets. So you could be worth $5 million. What qualifies as a retirement asset? Stocks or what?
Well, it would be in a qualified plan like a 401k. Or an IRA or a SEP IRA, something like that. The tax-deferred accounts are the ones that they're going to look at. Okay. They're not going to look at anything that's not tax-deferred.
Okay. And so what makes that number get higher or lower for a person if they wait till later when they're doing it?
That's a great question. So what makes it get lower is if somebody Dana's age, now Dana, just go with me on this, and I'm not asking your age, Dana, just go with me on this, but a young woman like you making a lot of money has got a lot of time, everybody, between 25, Dana, you're welcome, all right, and 60, for example.
Thank you.
Right? Okay, you're welcome, all right? Linda, an old bird like you and I, all right, we have less time. Linda, you knew that was coming, all right? So
does that mean our number is higher or lower?
Okay, Dana's number would be lower because she's got more time to invest. Linda, our number would be higher because we have less time to invest.
All the advantages go to the youth. Have you ever noticed that, Chris?
Yeah, I made both of you smile.
I'll take 25 all day long.
Linda, if I can throw something in there, something, and you asked me about this, Linda, earlier anyway, but as a certified financial planner, I just pray that our earners in this business are putting money away for retirement. You know, you can't retire on income. You've got to retire on assets. And, you know, even with the hot market of the last couple of years, when those markets have slowed down in some parts of this country, you've got people leaving real estate because they were taking orders before. They didn't save any money, Linda. They spent it all. And now they're just stuck in wind because they don't have the wherewithal and the assets to ride it out. So I just implore people to put money away.
Yeah. Love it. Okay.
Yeah.
Okay. Number 10. Okay. Number 10 is.
What about number 9? Did we already talk about?
Yeah.
Go ahead.
Did we do number 9?
We did.
Yeah, that was what we just did.
Oh, I thought we did stepped up basis. Okay, sorry, I got numbers wrong. Okay, good.
Sorry.
Number 10.
Number 10 is only for people who have a S corporation or a partnership as their entity. So here's another reason, Linda and Dana, for the S corporation, a pass-through entity, and they live in a state that has a state income tax. So, Linda, I know you're down in Texas, smiling from ear to ear. Dana, you're probably there too. But I live in the state of Illinois.
No, I wish.
Where are you, Dana?
No, I'm not in Texas. Anyway. Kentucky and South Carolina.
Okay,
but
so
anyway,
if you have
I have state income tax.
Okay. And this gets a very technical discussion, but this number 10 just came about in 2021, and it's in direct reference. Excuse me. It directly relates to what I'm going to refer to as the SALT limitation, SALT. The fact that the Tax Cut and Jobs Act of 2017, effective 2018 through 2025, limits the amount of SALT deduction, state and local taxes, that all individuals can take on their federal Form 1040 as an itemized deduction. They limit the SALT deduction to $10,000. So when you live in a no state tax like Texas, coupled with fairly low property taxes, the SALT limitation is much less impactive, if there's such a word, on Linda McKissick than it is on Chris Bird, who lives in a high tax state like Illinois, and then you got California, New York, New Jersey, etc. So here's what happens. The pass-through entity tax loophole allows the entity, my S corporation, to pay my taxes that I'm going to owe on my 1040 to Illinois on the profits of my S corporation. What I would owe individually on the profits of my S corporation in taxes to Illinois, the federal government allows my corporation to pay that tax bill. And in my case, everybody, it was $14,000 that I paid in December of 2022. So my S corporation paid that and took a deduction on my S corporation return called state income taxes. And that reduced my profit on my S corporation K1 that came over to my 1040 by the $14,000, which saved me, everybody, about $3,500. I mean, I'll take $3,500 tax savings every year when it didn't cost me anything. So you only get this pass-through entity tax loophole if you live in a state with state income taxes. There are 35 states, Linda and Dana, who have opted in to the pass-through entity tax loophole. Every one of our listeners should be talking to their CPA or their enrolled agent or their tax professional if they are an S corporation or a partnership or an LLC taxed as an S corporation or a partnership about the pass-through entity tax loophole. It is tax savings that don't cost you anything. Dana and Linda.
Awesome. Love that.
Great.
So what causes someone that's an LLC to be able to be taxed as an S corp? Your CPA does it that way?
This is really cool, Linda. I'm glad you asked this question. The LLC is kind of favored hybrid entity, everyone. So hear me out on this if you would. I'm going to give you 2 examples. Let's say that one of our listeners is a sole proprietor that is not an S corporation, is not a partnership, is not an LLC. All right. And they're listening to this and they say, I'm going to talk to my accountant about becoming an S corporation. Well, if you are a sole proprietor, all right, you cannot retroactively elect S corporation status. You would have to go out and file for your articles of incorporation, and this is already late March, everybody. So maybe you would be an S corporation as of May 1, having your attorney file all the papers. So for 2023, you would be a sole proprietorship for January, February, March, April, and then the rest of the year, by the other 8 months, you'd be an S corporation, and now you're off and running. Now compare that to the following scenario. And this, Linda, is your question. Now assume you've been an LLC for a couple of years, all right? Or even an LLC all the way back to January 1st of 2023. Linda and Dana, an LLC can make a retroactive election to file as an S corporation. The LLC is the only entity that has that elective permission to retroactively go back to elect to be treated as an S corporation. And Linda, they file a form 8832 to do that. The accountant knows this form. It's an entity classification election. So right now, any of our listeners, Dana and Linda, that are LLCs, if I've lit them up to talk about the S corporation with their account and they decide to do it, I'm telling you they can retroactively go back to January 1st and be treated as an S corporation for all of 2023. There you go.
Wow. Amazing. Okay. I got 2 random questions for you. This is stuff that's just come across my radar recently, and you may not know anything about either one of them, but I'm going to throw them out there to you because you're the smartest person I know in this arena right now. So one is this. I was at Monica Reynolds' house. I was at Monica Reynolds' house a few months ago, did a talk for her and spent the night with her, and she showed me a letter that her tax place sent out, I guess, or something, where you can actually defer your taxes. I think you had to be a certain age or something. Defer your taxes, and as long as your heirs keep the property, they don't have to pay those taxes. But when you sell it or they sell it, you do have to pay them. Have you ever heard of anything like that?
Well, I think what you're talking about, Linda, if you want to write this down, Dana, it's code section 2032A. 2032 capital A. All right. And what this is, it has its roots in the farm community, but it also applies to closely held family businesses. And here's what it means. All right. So in the farm community, and then you can take this to Monica Reynolds' situation, but in order to keep a family business from having to be sold to pay the estate taxes upon the death of the surviving farmer, all right, under section 2032A, if surviving family members continue to farm that farm for a period, look at my hands, everybody, for a period of 10 years, all right, then the value of the farm or small business is heavily discounted, Linda and Dana, so that the family doesn't have to sell the business to pay the estate taxes. So a family member has got to continue the business for a period of 10 years, and then the estate taxes are lowered tremendously on the value of that farmland or that closely held family business. And Linda, this could be a family business of a real estate business. This could be of a family business that owns a bunch of rental properties. Linda, this could be you and Jim for sure. And the code section is 2032A, capital A. I believe, Linda, that's what they're referring to.
Okay. Yeah, because I think
Monica, I'm sorry, Linda. If you would have Monica give you a copy of that and scan it over to me sometime, I'd be more than happy to look at that.
Okay, yeah, she sent me a copy. I'll do that. Okay, so that was just kind of
make
off
sure
the
you
wall.
have her permission to give to me.
Okay, I'll do that. Yeah, sure. I'll text her. Okay, so the next one is there is a company out there telling business owners, and specifically this is the real estate, but I'm sure
I know where you're going.
All business.
You want me to
they're
stop you right now and tell you
saying
what it says? Let me stop you and tell you what it says, Linda.
Yes.
There's a company out there that is telling all kinds of realtors that they need to file amended payroll tax returns form 941 to claim the employee retention credit. Right, Linda, am I right or wrong?
Oh, that's
is that about the PPP money?
No, it's not about PPP. This is about the employee retention credit. All right.
Okay. But Chris, will you answer that too? Chris, will you answer that too? First. Because I have heard a ton about the employee retention credit, and we've been trying to go back and get answers on it too. So I'm anxious for this one too. Okay.
Well, number one, let's talk about the employee retention credit. Be very wary of these companies, everyone. Number one. All right. And as a pricing accountant, I will tell you, my clients get the same letters. What they're trying to do is these companies say that they'll do the calculations, they'll prepare the 941Xs, they want your accountant to file them and all the good stuff. And then they want anywhere from 20 to 35% of the amount of refunds that you're going to get. And the IRS and Linda and Dana both, I want you to go to irs.gov. In the last 30 days, the IRS has issued another warning letter on its website about these companies. Now, they're not going to list companies by name or anything like that. But here's my concern about letting one of these companies come in. Number one, these companies are not concerned about the accuracy of whether your client qualifies for this. And therefore, they pick up no liability. Your client pays them the 20 to 35%. That company's gone. And now let's just say they get audited by the IRS. The company gets audited by the IRS. They don't care who pushed them this direction. They just care whether or not your client, that realtor, deserves the employee retention credit at all. Now, what they're doing is these companies are saying that because the pandemic had a partial or full shutdown effect for a period of time on the real estate community, they feel that your client qualifies. Well, I'm not so sure the IRS is going to go along with that. And again, I would take a look at that recent notice by the IRS on their website at irs.gov. And bigger than life, here's what I'd be concerned about. If your clients made more money in the years of the pandemic, and let me just tell you this, ladies, all of my real estate clients made more money in the 2 years of the pandemic than they made before. When the IRS gets into that, they're going to say, you really didn't deserve that money, all right? And therefore, you owe it back. So I am very negative, ladies, about these outside consulting companies coming in. I've dealt this, Linda, with our own market center in the last 60 days, all right? And I advise them to stay away from this because the market center has done fantastically well in the 2 years of the pandemic, all right? And I don't think they should go along. And the CPAs that are doing the work for the market centers are stay away from this. They're telling them the same thing.
Yep. So, I agree. I felt the same way.
There's my feeling.
Okay, let me ask you another question because I have felt the very same way from the minute I heard it. Let's say I am not in control of the business and the person that is in control wants to do it. Can I get some kind of indemnification from them? Indemnifying myself?
Well, number one, what is your position there, Linda?
It's not one. It's just an investor.
Yeah, just an investor.
Okay, gotcha.
So
gotcha. You're an investor, but you're not a controlling investor.
Right.
I'm sure that is impossible for you to be indemnified because of it. I'm not an attorney, all right, but I've never heard of such a thing.
Okay. Crap. Okay.
Sorry.
All right. I'm so glad I asked you because I felt exactly the same way. I feel like it's some kind of something that doesn't feel right.
Now, Dana, you wanted to use the words PPP. What were you thinking of?
Oh, I was thinking it had to do with the pandemic. So I didn't really understand all of it because I haven't even listened to the whole thing of it. I'm just hearing it from third party. And I'm just thinking that doesn't sound right. There were no losses.
Well,
How can you do that?
Let me make this differentiation. Okay, let me be clear on this. The PPP is one segment of government money that has come out, and the employee retention credit is another segment of government money coming out. Literally, and I feel very safe in telling you this, 99 9/10 of all PPP loans have been forgiven by the federal government.
Right.
Are you with me?
Right.
And there's no repercussions whatsoever, except for the people that went out and bought Maseratis with their PPP money and airplanes they didn't need and things like that. And if the government can chase them down, they will. And then I've got to do this. Everybody got just hear me out for 1 minute. I am very proud of the fact, I'm going to show you something real quickly. I'm very proud of the fact that Dale Carlton and I, another CRS instructor, we did about 10 seminars for over 10,000 realtors in the country during the pandemic. And we are told that people felt that we put over $500 million of PPP money in realtors' hands during the pandemic.
Wow.
And I'm very proud of that. And here's a Educator Contributor of the Year that I received, and so did Dale. So, I get red-faced when I say that, but I'm very proud that I put, if I did $500 million in realtors' hands, and that money has all been forgiven. All right. I feel totally different about the employee retention credit, Linda, as we've just discussed.
Yeah, love it. Well, that's a great point, and congratulations, Chris. I'm sure you earned that. You've put a lot of years into this industry, into helping realtors. So based on that, as we close out, where can people find you? Are you taking on any new realtor clients? Where can they find you?
Taking on any tax clients. I am doing everything I can to get rid of tax clients, to be honest with you. But my website is chrisbirdsseminars.com. I have a booking agent out of California. Her name is Ginger Sorosky. If anybody wants to book me, everyone, I specialize in the cutting edge for the real estate community and tax law. And I'd be more than happy to come and work with your board, your company, your convention, whatever the case may be. So chrisbirdsseminars.com.
Love it. Yeah.
Love it. Awesome. Well, Chris, we want to say thank you. I know I didn't even think about this when we asked you, but I just told Dana, I said, it's April. People are knee deep in taxes. We need Chris on. So thank you for during your busy time, making time for us. We appreciate that.
So
You're
great.
welcome. And no offense taken about the old hen comment, right, Linda?
Oh, yeah. I'm going to make sure Kate edits that out. That old hen thing's got to come out. But that's the beauty of editing. But it's a good guest when Dana has like 3 pages of notes, and then I just don't even bother. I get her notes.
Hey, Linda, you give Jimmy my best, would you?
I absolutely will. Chris,
give Jim my best.
Nice seeing you. Yes, I will.
Dana,
thank you.
Thanks, Chris. Thank you.
Hey, Chris,
so much.
Chris, stay on 1 minute. Let us upload, but I'm going to close this out. If you have not, please go ahead and hit the subscribe button below. We'd love to have you subscribe to our podcast. And the greatest compliment you can give Dana and I is to pass this podcast along to anyone that you think could benefit from these conversations. And if you know of a guest or you have a challenge or an opportunity or a question that you'd like us to bring up on our podcast, be sure and reach out to us at info@everything life and real estate. So Dana, I'll see you next week.
Be sure to subscribe for more business strategies and tactics to inspire you to live an abundant real estate life. Don't forget to rate and review so we can bring you the best content. Find this and other valuable information at everythinglifeandrealestate.com.